As for the main objective for this investment case, the dividend yield is what we're talking about. It's not a concern that the dividend yield fell. The yield is locked in at the price that the stock was purchased, and that doesn't change. But if the stock price rises and the investor can lock in a year's worth of expected dividend profits, and now the stock is overpriced maybe, they can lock that in by selling the stock at that higher price, and it might be worth doing so. Given the situation, it's at least worth looking around to see if there are better places to invest the cash and get a better yield. When there are, covered calls are great vehicles to plan an exit out of the stock while maybe selling a put on another stock.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 76, Covered Call Case Study. But before we jump in today, I want to thank the many listeners who purchased my new book, Build Consistent Wealth with Options. If you haven't yet, I know I'm biased, but I think you should. There's a lot of great stuff in there, some that we've covered on this podcast and a whole lot more. If you have purchased the book, please leave a review on the online store at which you bought it. When I was a kid, I imagined myself in different career paths. For a year or two, I wanted to be a lawyer. I wanted to be a trader at some point, and well, that one worked out. I had a stint of a fantasy of wanting to work for the CIA. And one recurring yearning was wanting to be a restaurateur. In my 20s, I almost pulled the trigger on that one. But you know what held me back? The widely cited statistic that 90% of restaurants fail. Now, to be sure, whenever I'm writing anything, and yes, I do try to script out most of my podcast episodes, I fact check. These days, it's mostly using AI, and my good friend ChatGPT says that 17% of restaurants fail in their first year, about half fail by the 5-year mark, and about a third fail by 10 years. And note, I didn't have ChatGPT back in my 20s, so I just sort of believed the 90% figure. Either way, it's kind of a lot. I spent some time asking myself why restaurants have such a high failure rate. And I looked stuff up, I chatted with people, and the consensus is that it's people who like to cook and are good at cooking open restaurants, but they don't know how to run the business. And hey, as much as I'm a foodie and all, what I do know is that running the business is by far more important than the food quality. McDonald's, case in point. This is if you want to make money, not pat yourself on the back as how good the food is at your restaurant. Well, it's the same with trading, right? Sure, it's interesting following the markets. It's exciting making trades. But you only make money if you follow a well thought out trading plan, if you run your trading like a business. And that was the point of writing Build Consistent Wealth with Options. And really the point of everything I do with Market Taker Mentoring too. And that's what we'll be talking about today. The logic and steps I took on a wheel trade on AT&T stock. I've owned stock in AT&T on and off, well, for a while, for several years. My main objective for this stock has been the dividend yield. For dividend yield plays, investors can use cash secured puts to try to acquire shares when the stock price is low and thus the dividend yield is high. And they can use covered calls to target selling the stock when the price is high and valuation is less attractive, and there are equal or better dividend yield opportunities out there. AT&T Corporation was paying a quarterly dividend of 27.8 cents a share. When the stock price was under 17 bucks a share, that dividend yield was over 6.5%. A case could be made that a blue chip stock like AT&T at that yield and with that low PE ratio, low valuation in general, a case could be made that it could potentially be an excellent holding in a conservative stock portfolio. That is when the interest rate that could be earned on a money market account within a brokerage account is below 5%. The higher the dividend yield is compared with money market rates or maybe treasury securities, the better it could be to hold that stock, presuming the risk to owning the stock is also justified. A low valuation for the stock implies less risk, hinting at proof of the advantage for investing for the yield. And as a bonus prize, one could also expect to make money from the stock appreciation as the price catches up to value, as over time, theory goes, it should. So the dividend yield changes as the stock price changes, of course, right? When AT&T stock later rose to be trading above $27, yield worked out to just only about 4%. Now that's, of course, if you buy the stock at that price. At that higher price, the fundamental value case was consequently weaker as well, though it was still decent at this point in time that I'm talking about. Falling interest rates coincided with the rise in stock price. That same money market was paying out about 4% at that point. As for the main objective for this investment case, the dividend yield is what we're talking about. It's not a concern that the dividend yield fell. The yield is locked in at the price that the stock was purchased, and that doesn't change. But if the stock price rises and the investor can lock in a year's worth of expected dividend profits, and now the stock is overpriced maybe, they can lock that in by selling the stock at that higher price, and it might be worth doing so. Given the situation, it's at least worth looking around to see if there are better places to invest the cash and get a better yield. When there are, covered calls are great vehicles to plan an exit out of the stock while maybe selling a put on another stock. Around the time AT&T stock was trading around 27 bucks, I began selling just out of the money calls while selling just out of the money puts on Verizon Communications, symbol VZ, which had just fallen to around a 6.5 dividend yield and had a better valuation at the time than AT&T. I always go through the usual exercises of analyzing volatility and optimizing theta, which we've covered quite a bit on the show so far. So let's cut to the execution, and then we'll focus on management. It's good to think about option trading as the fact that options trade as a percentage of the stock price. With AT&T still, at the time, in the low double digits, around 27, options prices were very low in absolute dollar terms. This is especially true on a boring old blue chip like AT&T, with options implied volatility typically fluctuating between 22 and 28. Just selling a slightly out of the money 1 week or so option, it isn't going to work. A 7-day option, 25 cents out of the money, might get you around 20 cents in premium. If commissions and fees come out to $1 a contract, 5% of the maximum profit would be expensed right off the bat in cost. 1 cent option premium is $1 of money, right? So 1 divided by 20, that's 5%. And so investors need to use longer dated expirations on stock options series like this, probably selling a call with several weeks until expiration most of the time. So maximizing theta with short-term at the monies kind of goes out the window a little bit. But can investors still benefit from at the money calls anyway? Or are in or out of the money calls better? Let's take some time and explore some different moneyness choices for this play. First up is the case for selling an in-the-money call. This is a go-to choice to increase the likelihood of assignment. There's more of a hedge because the in-the-money call allows for the stock to fall some and still get assigned. It can fall to the strike price and still be a good candidate for assignment. But there's a compromise. The compromise is lower time premium. And that's the main benefit of using covered calls. The time value benefit is more marginal with lower priced options. That's because, again, expenses can eat disproportionately into profits. And it's also because the bid-ask spread is naturally wider on in the monies, which amplifies the shortcomings of low time value. If the stock price wasn't so low, and if the dividend yield and the valuation were worse, this might be a case for selling an in-the-money call. But we want the dividend yield. How about an at-the-money call? Okay, so an at-the-money call has around a 50% chance of assignment and does have the biggest amount of time premium, but it's not until the expiration date is a month or so away until the time premiums got much above 50 cents. And never lose sight that this game here that we're talking about, the wheel, is played in cycles. When every roll gives up commissions and fees, as well as market maker edge, the higher rate of decay of the shorter term cheapy options can be pretty much nullified. Even a month away expiration sometimes isn't always enough. A lot of times I'll sell a call with at least a couple of months until expiration on stocks like this. And yeah, I appreciate that that's a long time to wait to see if the slightly better than a coin toss odds of the in the monies for assignment, see if they actually pan out. The stock can move a lot over time, and that's going to affect my plan. But trading in cycles means playing that long game. The at the monies can be a good play sometimes. It's wanting to sell the stock, but not needing to sell the stock. That's how I would describe selling at the money covered calls. All right, let's go back to what about selling out of the money covered calls? This methodology definitely has its place too. Out of the monies make the most sense when the valuations aren't great, but aren't terrible either. It's not urgent to sell the stock. In this case, the investor can set an out of the money strike price for the call at a stock price in which the valuation is more unbeneficial. Of course, the problem is that out of the money calls might not have enough premium. I've found, specifically when trading AT&T stock options, I've had to enter good till cancel limit orders for far out of the money calls to get the premium that I want, the premium that makes it worth selling. I'd have to wait for the stock to rise enough to get there. I've got a couple of pro tips here. Pro tip number 1, going out to a longer dated expiration, it gives the stock time to rise because the delta helps the market's bid for the call to reach the resting call limit offer that I have in good till cancel. Resting good till cancel orders are also less likely to get a mid-market fill. Number 2, resting good till cancel orders are less likely to get a mid-market fill. The offer typically will fill when the market's bid rises to the offer price, or if once the call offer is the best offer out there, right? The stock rises enough, it doesn't get filled yet, but your offer represents the market offer. Well, somewhere in the world, sometimes, there happens to be somebody who wants to buy it right at that time. Doesn't happen all the time. But the important thing is, as an investor, you should focus on the value of the premium that is providing you value and less on giving up market maker edge. Pro tip number 3. Monthly as opposed to weekly expirations are usually more liquid and more likely to lead to a better fill. Weekly options, you might get lucky and get a randomly good fill, but we don't like to rely on luck. Pro tip number 4, accept that it's possible that the trade will never execute. That's the nature of selling these out of the money, good till cancel orders where the limit offer is above the market. The stock has to rise some amount in order to get filled, and it might not. Finally, pro tip number 5, always calculate the static return based on a rough estimate of where the stock may be if and when the call offer does execute by backing the stock price out of the call metrics. Let's expound upon this a bit, shall we? Imagine AT&T is trading at $27.35, and this is straight out of the book here. The 28 strike calls expiring in 10 weeks are 84-cent bid, offered at 86 cents. That's a 16% annualized return. Okay, that's okay. Maybe it's possible to do it better. From here, one can arbitrarily choose a higher potential call sales price to explore optimizing static return. We'll continue by sizing up what it would look like if we put in a $1 offer for these same calls, GTC. Again, with AT&T at $27.35, a $1 call premium on a 10-week call would be an annualized static return of 19%. Better, the market typically returns 10% a year, right? The stock has already had decent price appreciation. So the question becomes, am I willing to earn 19% a year if the stock doesn't rise much and I don't get assigned? And if that answer is no, run the math for a higher call premium. If it's more than enough, calculate based on a lower premium, which increases the chances of assignment because it increases the chance of getting filled. But there's a problem. With the stock at $27.35, I can't sell the call at $1. The call is 84-cent bid in this case, remember? So we need to crunch some numbers. The relevant data for the 10-week 28 strike call are, the market's 84-cent bid offered at 86 cents. Volatility is slightly overpriced. The delta in this case is 37, and the theta is 0.7 cents in this example. Based on delta, for the 84 bid to increase to $1, the stock would have to rise 43 cents today. That's stock price times 37 delta equals 16 cents call bid increase needed to get from 84 to $1. So using some algebra and simplifying, we get the stock price equals 16 cents divided by 37 cents, and that's how we arrive at the 43-cent share appreciation needed to get filled on our call. So the stock would have to rise 43 cents from $27.35 up to $27.78. Okay, that's really just phase one. That's if the stock rises that much today. We need to factor in some guesstimate for the number of days it may possibly take for the stock to trade high enough to give it a shot at getting filled, because we have to factor in theta. And of course, this guess will always be wrong, and that's okay. We'll just kind of spitball a little. Let's speculate that maybe 4 days is a reasonable amount of time for the stock price to fluctuate enough to possibly result in the call offer being executed. That would mean the math would need to account for another 3 cents of option premium to make up for 4 days of theta loss, right? Because our theta was, 0.7 cents, right? So 4 days times 0.7 cents of theta is 2.8 cents of theta over that 4-day period. And we can just round that to 3 cents. Now, revisiting our old friend delta, The stock would have to rise another 8 cents for the call to rise enough to make up for that 3 cents theta, right? 3 cents of call time decay to be made up for by that 37 delta times the additional stock price increase necessary, right? 3 cents divided by 37 cents equals the stock price increase. So this back of the napkin math means if we want to target selling these calls at $1 to give 4 days time for it to happen, the stock would have to rise now. The number comes out to $27.86. That's $27.78 that we calculated last time just using delta, plus the 8 cents it has to rise to make the call price rise another 3 cents to make up for the expected time decay over 4 days. If the call doesn't trade within 4 days, doesn't execute because the stock doesn't get there, then, well, it's time to run some new numbers. So this number that we've arrived at here, $27.86, is a better estimate for the input into the static return calculation. That's a good enough rough guess for where the stock will be for the call bid to rise enough for the dollar offer to get filled over the next few days. That $1 of call premium with the stock at that new calculated price of $27.86, that comes out to an 18.7% annualized static return. And so note kind of what's going on here. We're just trying to be more accurate in calculating the static return. If we sell it at the calls at 84 cents against where the stock is now, what I say, 27.35, that comes out to what that comes out to. But we're wanting to sell a higher price call and the stock price will be higher. So we're dividing that higher price call that we want to sell, $1, divided by where the stock will have to be in order to actually trade at $1, which in this case is now 27.86. So both the call and the stock are higher. So the annualized static return changes a little, but not that much. Because we're dividing a higher call price by a higher stock price, the annualized static return is not going to change drastically, but it's going to change some. So we do the calculation anyway. Managing the trade is interesting. How does this stock investment make money? Well, the primary goal is the dividend yield. The ancillary benefit is stock price appreciation. And that's it, right? Well, no, it doesn't have to be, because we can add the call premium to that calculation, call premium cash flow. So whatever our moneyness choice is, we kind of arrived at maybe at the money would be okay, or maybe this out of the money one would be okay. There is some flexibility and forgiveness with this. If the stock does not get assigned, if we don't execute the call and that call consequently doesn't get assigned, well, there's no harm. At least if the current stock price is not so overvalued, it is at risk of falling greatly, or worse yet, at risk of the company cutting its dividend. The dividend yield is still locked in at whatever the original buy price was. Presumably, I think I said earlier, 6.5% dividend yield. That's locked in. But if the dividend gets cut to a lower payout, well, that changes things. If the call is at the money right around expiration, rolling to another at the money, that makes the most sense for this situation. At a quarterly dividend of 27.8 cents, every $1.11 of option premium taken in is a year's worth of dividend payment. Earning something around that much in just a couple of months instead of a year, well, I mean, that's better than holding the stock for a year, right? It's better to earn it faster. And depending on value versus price of AT&T stock and the availability of other yield opportunities, it might be worth the risk of getting assigned next time around and losing the stock. And if the value's still good enough to want to keep the stock, well, that's when rolling up and out to a higher strike becomes an optimal play. If the call's in the money at expiration and a better opportunity exists, nature can take its course. Investors can accept assignment. And if no decisively better opportunity exists, Maybe in that case, the optimal play could be a net zero roll or a premium gambit roll if they're possible. And if no better play exists, the stock play must be evaluated on its own merits at that snapshot in time. The most logical approach is to treat the existing call as if it were to be assigned and weigh the merits of selling a cash secured put on the stock. And if selling a cash secured put makes sense before the covered call expires, it might be worth rolling out to a further expiration at the strike at which you would want the cash secured put. I'm talking about synthetic logic here, which we've talked about before, right? And the thing with using the wheel on strategies like this, I like to call it you're right even when you're wrong. It's kind of the magic of the wheel strategy. I've got the trade objective to sell the stock, but my call wasn't assigned. So I keep a premium and I still keep collecting dividends. If the stock goes down too much, I might still be happy to continue owning it, and the pain, in quotes, of the stock falling is lessened because it doesn't matter. I still have the same dividend yield locked in, and I'm still collecting option premium. If I do get assigned on this trade objective covered call, I may have given up some upside, but I kind of still killed it on the trade and can continue with a new trade on the stock if it makes sense, and only if it makes sense. And I trade in cycles. So in the long run, I don't care about the amateurish thought that, oh, geez, I left money on the table. That might be true now, but it may very well not be true later over a longer cycle. When I was a clerk many years ago, I worked for a trader, Don, and Don once said something like, that's the thing about selling options. You're always wrong. And you are. The stock never does exactly what you want it to do. It goes down too much and the position loses. It goes up too much and misses out on profits. Negative gamma is always working against you, but the wheel keeps generating option premium, and that smooths out the results. Even if I'm wrong, I'm still right. Again, that doesn't mean I always win, but when the stock seemingly doesn't cooperate, the cumulative option premium continues building. And that about wraps it up for this show. But before you go, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. And if you're already subscribed to the show, you can go even deeper and get more with a paid subscription. With your paid subscription, you'll get video extra podcast episodes so you can get hands-on video training, subscriber-only posts where I drill down on a stock or event and share trade ideas. You'll get all my covered call and cash secured put trades I'm making in my real brokerage account, access to our monthly Ask Me Anything webinar, and you'll get our unusual activity options alerts. And the best part is your paid subscription keeps this show on the air. So I'd like to take a minute to thank our newest paid subscribers. Thanks, John L., Tim T., and Linda B. To join the list of Wealth Building paid subscribers, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com, and then just choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching and our Smart Income video class, which alone is worth more than your Wealth Building with Options paid subscription. Again, that's wealthbuildingpodcast.com. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.